All right, time to go over one more very important aspect of fundamental research. This aspect is tokenomics or token economics. Okay, so we're here on CoinMarketCap or CoinGecko, and we know that this list is rankings in order of market cap. Okay, so Bitcoin is in first place because it has a market cap of 1.08 trillion, and in the number two spot is Ethereum with a market cap of 200 billion. So these coins are ranked in terms of market cap. Okay, so the first few aspects of tokenomics we're going to talk about is the market cap and the supply. Okay, we know that a market cap is a coin's growth potential. Okay, and the market cap is a factor of supply times price, right? So if there's 18.6 million BTC in circulation, as you can see here, and you multiply that by the price of 57,000, you get to its market cap of 1.080 trillion. Okay, likewise 115 million ETH multiplied by its 1800 price tag gives it a market cap of 210 billion, and so on. So some people mistakenly confuse, price for earnings potential when in fact they should be looking at market cap. And the best example of this is something like Doge. A lot of people talk about, they think a coin is expensive and they want to buy a cheap coin. So they want to buy Doge and they think it can go to $10, for example. Dogecoin is a meme coin. It started off as a meme, pretty much a joke. It has had its fair shares of pumps and dumps, but we can see that Doge is at 5 cents here, right? And the reason it's at 5 cents and it's number 19 in market cap with a market cap of 7 billion here is because of its large supply. Look at this supply, it's just insane. 128 billion Dogecoins in circulation. Okay, that's why with such a low price, it can have this market cap of 7 billion. And we cannot confuse that for earnings potential. So start thinking of earnings potential in terms of percentage gains, okay? Now, Doge will never be $10, right? Because, that's a 20x, not 20x to $1 and then a 10x, right? So that's a 200x, and that'll be a 10 trillion, $20 trillion coin, right? And that's just not going to happen, right? So you have to think in terms of market cap. Okay, those just getting to 10 cents would be a 2x move, and it would take it to a 14 billion market cap and place it in the 9th spot in the market cap rankings. So this is harder to do, even though Doge is cheaper than something more expensive, for example, like Yearn Finance, which has a price tag of 35,000. But the reason it's a market cap of 1 billion here, 1.2 billion, but there's only 36,000 coins in circulation, and that explains why the price tag is so expensive, right? Because it has a very small supply. Okay, so market cap is a factor of price times supply. We have to think in terms of market cap and percentage gains. It will be a lot easier for this to double in price and reach 2.6 billion here, because that will only place it in maybe the top 50, right? Then it will be for Dogecoin to double in price and enter the top 8, because the market cap has more room for growth. Okay, so that's market cap and circulating supply. Another thing to notice about supply is how much of the supply is in circulation. You can see this gray bar here. Bitcoin here has about 89% of supply in circulation. We just saw with Yearn Finance 100% of supply with 99.9 in circulation. These coins are 100% here. Some are like 50, as you can see here. And you got to keep this in mind, because the less amount of supply that's in circulation is the more that is still oncoming. And increasing supply should cause negative pressure on price if demand, aka token buying, does not increase at the same rate. Okay, the oracles are notoriously, they start off low. Filecoin right here only has 3% of supply in circulation, so there will be a lot more supply being released over time, right? So it's inflationary. So that takes us to the next aspect of tokenomics, whether a coin is inflationary or deflationary, right? And some coins have a finite supply, like Bitcoin. There can never be more than 21 million, which makes it deflationary, even though the mining rewards are released to the miners. you would think it's inflationary, and it is to a certain point, but the fact that it has a maximum total supply, and the fact that, you know, some people, that the halving every 4 years happens, and the mining reward is reduced in half every 4 years, reducing that supply pressure on price, and the fact of loss, right? Some people lose their Bitcoin, forget their passwords, etc. So it can end up being deflationary, and it will when max supply is reached. Other inflationary coins like Polkadot, for example, it has no maximum supply. It's inflationary, and most of the times this is used to pay validators and delegators for their staking. They're staking their coins to help secure the network, and, you know, new coins are minted and they're put into circulation in order to pay those rewards in DOT tokens, right? And so that's why some coins are inflationary. You don't want to see something more than 10 to 15% inflation, and you also want to see a lot of utility for a coin, and a lot of things that will drive demand, right? A lot of deflationary aspects as well, like burning tokens if possible, okay? Some coins like to burn tokens. An example of that is Terra Luna, and you can read this all on each token's white paper, guys. Like I said, I recommend to read their white papers. Luna has a finite supply like Bitcoin, but they actually have burning mechanisms where over time they are burning Luna tokens, causing a deflationary pressure on price, which is very price positive. Okay, now let's talk about token emission schedule or release schedule. Usually you want to see a smooth curve, and I'm going to show you what that looks like. We're going to start here. We're going to take a look at what we don't want to see with GRT. You can see that from 0 to 6 months, it's smooth, and then you have what they call a supply cliff. This is a supply cliff because overnight, or over the course of 1 week or 1 month there, the supply pretty much triples. You can see it goes from about 1.5 billion to about 5 billion, right? So a 3x or more increase overnight. That's set to happen about 6 months after token issuance, and that should put a lot of downwards pressure on price. What you want to see is a token release schedule that's very smooth and focused on the long term, something like this. This is a 50-year, this is the longest I've ever seen, but you want to see a token supply curve that's very smooth, right, with no sudden cliffs or token releases in the vesting schedule. Okay. Let's take a look at something else here. Let's take a look at Solana to show you one of the worst we've ever seen. With this December 2020, we went from about 10-15% of token supply being out and circulating to over 90% overnight, right, or over the course of 1 week or 1 month there. And let's go take a look at what effect that had on price in December 2020. We have the Solana price chart here. And you can see end of November here, we're at these highs, November 26th, November 27th. And if we grab a price tracker, you can see that we went down 60% in 1 month. Right? 60% in 1 month, and then December 23rd around Christmas, it finally found a bottom. But 60% is insane, guys. 60% is bear market stuff, and this happened in the middle of a bull market, right? And this actually, look at this. If we turn left from the highs here in September, this thing started to sell off. From September to Christmas, it sold off 80%. You know, some people are probably anticipating this by looking at their token release schedule and wanted to take these profits while they could. And the other thing is, once these tokens were released, these people were taking profits, right? Once they were vested to the team and to the investors, these people were taking profits. So another thing to keep in mind is the vesting schedule, and we're going to look at that on the white paper very soon here. So on the white papers, you'll see if a coin has an inflation rate, and like I said, anything over 15% is probably way too much. You want to see an inflation rate, 8% is okay. And you want to see a inflation schedule that's reducing over time, which means that the staking rewards that they're giving to their validators and delegators are, you know, reducing over time, especially as more people are validating the network and staking their coins, right? And you want to see as supply increases, you want to see inflation decrease, right? So that's good to see there. Talking about staking, this is a very useful tool right here in stakingrewards.com, where you can go view the percentage of a coin's circulating supply that's being staked. Obviously, you want to see a very high percentage, and you can see the leaders here in Cardano with over 70% being staked, closely followed by Polkadot here, AVAX is 77%. I don't know why that's in that order, but this is what you want to see, right? The higher the number, of course, the more people that are staking their coins to receive those rewards, which means that more coins are out of circulation. That means they're not on exchanges ready to be sold. And a lot of these staking protocols have unbonding periods, which means if somebody wanted to unstake because price is rising so fast, they wanted to unstake and move their crypto to the exchange to sell it and realize these gains from the price appreciation. Some of these have unbonding schedules like 28 days or 10 days or whatever it may be, so they won't be able to do that right away. So it's good to see a good percentage of coins being staked. It will help to reduce downwards pressure from selling during a price rally. In a way, they're more dip resistant, right? Because these coins are locked away, being staked. Anything that can reduce tokens and coins from circulating supply is price positive, right? Now we're going to take a look at wallets, and you can go to Block Explorers and take a look at different tokens and their different stats. You can find their market caps here, but we're going to check holders tab right here to take a look at the wallets. This is Etherscan, where you can check all ERC20 tokens, which are tokens built on the Ethereum network, right? So we're looking at engine here, and we're clicked on holders, and we can see the different wallet addresses, right? What you're looking for is, first of all, you never want to see one wallet, one random wallet, a random address like this with more than 10% of the total supply, right? There's some, I think at one point Dogecoin had 30%. One wallet held 30% of all total supply, which is just crazy because it gives too much power in the hands of one person, and you don't know if this person or wallet can ever sell or dump all these tokens on the market, which would really dump the price, right? In this case here, 10% is the highest, and it does belong to Binance. And you can see a lot of these high Bittrex here, Crypto.com, Huobi. A lot of these, you got Aave here, are exchange wallet address, which is okay because exchanges have these wallets for liquidity, right? You can see this is probably the engine team themselves after the token sale. This is their tokens that they earned and that's being vested to them. You can see when it has this little thing here, it's a smart contract, right? Which makes sense because they have a vesting schedule. For example, the team, after 2 years starts to receive their tokens in, 10% every 3 months, a vesting schedule programmed by smart contracts. So this makes sense here. That's 6%. You can see the smart contract ones, those are okay, and everything else is very small holdings. So this is a pretty good one right here with engine. Just be aware of any large wallets that are neither an exchange nor a smart contract with a large amount of tokens, okay? So taking a look at the Kilt white paper here in their token economy section, you want to see a white paper show you the utility of the token. So the different token functions, you can see they're paying fees and gas fees, and when you're paying for an attestation, transactions, distributing block rewards to the validators, this is in staking. You want to see a lot of utility for the token. Governance is another one. Usually for holding tokens, you can vote on the direction to take the blockchain. So those are governance structures in place to drive more demand for the token holding, right? Token emission, you can see 40% of the token will be pre-mined and distributed before the launch of the network. And then 60% will be available minted over time and rewarded to those who help secure the network, right? You can see that the block distribution is designed in a way that after 50 years, all 1 billion tokens will be released and there are no more block rewards after that. This is similar to something like Bitcoin with a finite supply and the block reward being cut in half every, let's see right here, every 10 years. So we'll consider half-life of 10 years to give it balance. Then every 10 years, the remaining tokens to be minted will be halved. So the rewards for delegating and validating will be cut in half every 10 years. That will happen 5 times, right? And after 50 years, all tokens will be in circulation. So this is a bit inflationary, though it gets better every 10 years with the rewards being halved, that inflationary pressure. So you can see that the token rewards are meant to incentivize providing security and consensus about the state of the blockchain through mining that would be performed by validators. Again, this is very common in proof of stake protocols and mining protocols as well with proof of work, giving these validators and miners rewards for helping to secure the blockchain. This incentivizes holding as well, which takes off selling pressure. Again, Validators need to stake kill to be able to take part in the validation process. Requirement for staking increases the scarcity of kill. So the last thing you want to see and focus on tokenomics is the token allocations. And we're looking at the Kylan white paper here and its token allocation table. So a couple things you want to take note of here. You can see the mining incentive here, the 10-year vesting period after the mainnet launched to reward the validators. Again, this is okay. This is pretty standard. Community funds and foundational reserves are all for the ecosystem. Okay, this is usually okay. Some things to take note of are things like advisors, private sale, and seed sale, and the team, right? You don't want to see more than maybe 30% go to these kind of things, to these small private parties, and you definitely want to pay attention to their vesting schedules. So you like to see things like this: 0% unlocked for the first year. They don't have access to any of them. And then monthly vesting over 24 months. The advisors, 0% unlocked for 4 months. Then monthly vesting for 18 months, right? Again, the private sale, they got 20% unlocked on the TGE, which is the token generation event. And then monthly vesting over 9 months. You'd like to see these a little longer, maybe all of them 24, but you can see the private sale and the seed sale, 6% unlocked on TGE, and then monthly vesting over 12 months, right? But you know, you got 9 and 9 is 18, and 7 is 25, and 3 is 28. You don't want to see much more than that, more than 30 for these kind of pre-sales and private sales and team and advisors, right? And if you do, you definitely want to see them look more like this: 0% unlocked for a while and a long monthly vesting period, so you don't get any selling pressure on the market. Okay.